Okay, year 13, let's have a quick look through public limited companies, PLCs. Okay, look at the features, pros, cons, and private equity groups. So it'll be pretty high speed, hopefully. Um, you've got some features of a PLC in your textbook. You should already know quite a lot about them. But let's just run through. I'll just run through pros and cons, and that'll really give you the features. A public limited company is essentially a limited company, the same as a private limited company was. That is, it's a company, it is a distinct business that is separate from the owners. So it has the same features in that regard as a private limited company. It also, as the phrase limited would imply, has limited liability. That is, the owners have limited liability, the shareholders have limited liability for debts. So their liability for debts is limited to the value of the investment that they placed in the business, and their personal belongings will remain protected in the case of the business failing and going into what we would call liquidation, where it's shut down and the assets sold off to try to recoup some of the outstanding unpaid debts. The key difference between a private limited company and a public limited company is that a public limited company, as you might have guessed, can sell shares to the public. And how does that happen? Well, the shares would be sold on the stock exchange. You would say that the business is floated on the stock exchange, and that just means that the shares are available to buy and sell to the general public. What are the reasons for that? Well, the main reason is to provide more capital generally for growing the business. So say, for example, if you wanted to grow your business and maybe move into different countries and set up new factories in other countries, that sort of thing, then that's going to be very expensive. That's going to cost multiple millions of pounds in most cases. If you only have, say, a small family firm with private limited company status, you're going to have a very restricted number of people who can actually become shareholders and invest in your business. So that business model may not be compatible with the level of ambition that you have for the growth of your business. In that case, then you've got to consider expanding by selling shares to the general public, and that's when you should think about becoming a PLC. There is a minimum investment level, a minimum share capital of £50,000, but that figure is really it's really irrelevant now, because that figure's been around for probably 30 or 40 years, and there was a time when that maybe seemed like a significant amount of money, but realistically now, I spoke with a stockbroker about this, and I said, what's a realistic figure to think about floating on the stock exchange in terms of your company valuation? And he reckoned 20 to 30 million, and he said, look, if you're anything less than that, then realistically it's not worth your while in terms of the fees that you would have to pay to merchant banks and just the cost of promoting the flotation, because you've got to make potential investors aware that your business is actually out there and the shares can be bought in it. So the £50,000 minimum is it's still valid, it's still a legal minimum, but it's not a practical figure. There are lots of private limited companies that have more than £50,000 worth of share capital. So anyway, the main reason is it gives you funds for growth. It gives you more credibility with lenders, suppliers and customers. There is a significant kudos or status improvement associated with being a public limited company with listing on the London Stock Exchange. And we mentioned already about shareholders having limited liability. Downsides, as I mentioned already, the cost of the stock market flotation is going to be substantial, and realistically, that is going to easily get into hundreds of thousands of pounds. And if you're looking to raise substantial amount of money on the stock exchange, that could easily get into the millions. It's usually a small percentage of the cost, but the total market capitalization. That is the value of all the shares sold on the stock exchange. But um, it's a pretty substantial undertaking, and the professional bodies who would get involved do so because it's very much in their will to do so. And it's not going to be a few £1,000. It's going to be hundreds of thousands. There's a loss of control because, in terms of the another downside of a public limited company, selling your shares to anyone and everyone via the stock exchange means that anyone could come along and say, right, I'm going to buy a substantial chunk of this company because I like it and I think it's a good investment, but I want to have control. So essentially this is what happened with Manchester United a number of years ago, where the Glazer family came along and basically said, right, we want to buy a majority stake in Manchester United and become the owners, majority owners, and control the club. And essentially they didn't just do it in one chunk, but they did it in a number of steps where they bought up significant tranches of shares until they owned more than 50% of the shares. And once they got to 51%, they called an emergency general meeting of all the shareholders and they had a vote. And the single item on the emergency general meeting agenda was the majority shareholder would put forward that or proposes that the remaining the other shareholders sell all their shares to the majority shareholder. All those in favour say aye. No, only Malcolm Glazer put his hand up. All those against say no. Everyone else said no. Malcolm Glazer said, well, I've got 51% of the shares, so actually I win. That's democracy in action. And so it proved. Very controversial, caused an awful lot of bad feeling with a lot of Manchester United owners and fans, but that's how it happened. And essentially then the Glazer family took control of Manchester United. So that can happen. Risk of takeover. Large businesses are often less flexible because you've got to state exactly what the nature of the business is. You can't just chop and change that. Also, you have to get agreement from shareholders if you're going to do that sort of thing. If you're making those substantial changes, that would have to be approved in an emergency general meeting or the annual general meeting of the shareholders. Day-to-day running of the business is done by the directors. The shareholders are not involved in that, by and large. There may be a few institutional investors who maybe own, it could be even like £10 million worth of shares, or maybe more than that, and they would say, right, well, if I own that much of the company, then I want to have some say in how the business is run, because if the business is badly run, I'll be so seriously affected by that. So there's some logic there, but that can be very much in the short-term interests of that institutional investor, and that's not always the best way to govern the company. There's a loss of personal touch because of the size of the company, and your accounts again are public, even more so than the way the private limited company ones were, because your accounts are not only available on Companies House, but generally would be available on your website, and it would be required of you that they're made available to financial journalists and the media in general. Okay, so you've got a few things you can look over there with your notes. So that's pretty much private limited companies. Okay, hi year 13 again. It's Mr. Sinclair. We're just going to run through the last of our different business formats, and that is franchising. So we're going to find out about what is it and the two different types. So there's business format franchising and there's product and trade name franchising. And we won't worry about the research tasks. We did them a long time ago. This is just revision. So a franchise is essentially a license to trade under another company's name. So it's an agreement between two parties which allows the franchisee the right to market a product or service under the trademark and possibly the business formula of another firm, so the franchisor. So the franchisee is the person who wants to take on the trademark of a bigger, more established business. In return, the franchisee normally agrees to pay the franchisor fees up front and ongoing royalties, although there are some variations to that, as we'll see in due course. So, business format franchising, this basically means you buy the way they do it. So in other words, we have Subway's logo up here. If I wanted to open a fast food sandwich chain, not necessarily a chain, a restaurant, let's call it, then basically I would contact Subway, I would fill in lots of forms and agree to do it the Subway way. The Subway, you know what I mean. And basically I would take on not just their trade name and their signage and all that kind of stuff, but I'd have to sell Subway products, I'd have to have Subway menus. I couldn't have my own promotional offers that I decided, this week we should have a Sinclair sub with all sorts of weird and wonderful food in it, ingredients in it. Subway don't want you to have any creativity that way. They want you to do it their tried and tested way, okay, and stick to their plan. So it's the most common form of franchise agreement. There is quite a lot of support. So Subway, for example, in this case, they would offer a franchisee, which is me in this example, trademarks, logos, but the whole system of doing business. They basically have a best practice manual, if you like, and they just basically tell you how to do everything, and that would include how you set up the shop, the layout of the store, the standards of hygiene that are expected, how you hire staff, how you train staff, how much you should pay staff, legal issues you should be aware of when you recruit staff, if you promote staff, how to deal with any staffing issues, how to treat the customers in terms of the standards of service that they've come to expect from Subway, all the pricing policies, issues with refunds and credit notes, and how you store the stock and food hygiene, and really you name it. Okay, everything you can think of about how you do business at Subway, they would have a simple format for you to follow. The franchisor would assist the franchisee with finding a site, how you set up the interior of the business, and all this other stuff that's listed that we've discussed. They'd also undertake research and development, so they would develop new products. You wouldn't have to come up with some new magic sandwich, they do all that centrally, and then they would just give that information out, make those product lines available to the various franchisees. They would provide marketing support for everybody as well. So there's essentially a national, and in some cases an international marketing campaign. So you don't have to be putting little homemade posters in the window of your Subway restaurant. They can do that for you. And that would mean that you don't have to worry about that. You just do it the Subway way. Okay. In return for those services, a franchisee pays a substantial upfront franchise fee and ongoing royalties to the franchisor. So that would mean that now for a fast food situation, that could be a couple of £100,000, and if you went for a large fast food franchise like McDonald's, probably one of the most expensive, you're talking about, if you're talking about the one in Belfast, you're talking about maybe 500,000 quid to set that up. But then, you stand to benefit quite substantially from the profits when they roll in. Another downside is the ongoing royalties to the franchisor. Just to quote from McDonald's, you're going to be paying 28% of your turnover to McDonald's if you're a franchisee. Now, that's not profit, that's turnover. That's the top line. That's before you pay for your supplies of foodstuffs. That's before you pay your electricity bill. It's before you pay wages to staff. That's all of those things. So you've got to, it's a pretty substantial sum to take off the top before you've even paid yourself to work there. It's a very popular format in fast food restaurants, if we mention KFC here as well, estate agents and recruitment agencies. So that's business format franchising.